And of course, all this is on the oil surging the most in 4 years because tanker traffic halted through the Straits of Hormuz and the escalating conflict in the Middle East. All of that threatening supplies. Here to talk about this and the morning's markets, Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Andrew, thank you as always for joining us. Let's start with oil. It's going pretty much where everybody expected it to go today, it seems.
Yeah, pleasure being here, Roger. This is, a different risk than we saw with Venezuela, Roger. Analysts are looking at this as being a more protracted affair with respect to Iran, and now what we're seeing is a spreading out across the Middle East, which is obviously going to have a positive impact for the price of oil. Some analysts, as you've mentioned this morning, looking at the potential for crude to get to $100 a barrel. Obviously, there's nobody out there that can rule that out, especially if this conflict continues for a week or 4 weeks, as Trump has alluded to.
And I imagine, Iran makes up, I think, about 5% of world oil, but it's the Strait that is the big thing, isn't it? Keeping that open.
Exactly. It's the Strait. It's where we see the passage of a fifth of the world's oil production in terms of supply distribution. It's not just Iran. So we're seeing that directly on the impact on crude. We're also seeing it with respect to, for example, gas prices in Europe, because, again, a lot of your LNG production is in that region. And two of those suppliers have basically had to shut down amidst the conflict and the threat levels in that region. So it's going to hit crude. It's going to hit nat gas, I think, as we worked our way through this.
Yeah, did I not see Norwegian nat gas was just jumping?
This morning we saw a 45% spike in that price. So, that just tells you the sensitivity of supply in Europe to production in the Middle East. It's no longer just an Iranian oil production issue. It's now refineries and, again, tanker shipments through the Strait.
And the President Trump has said this could go on. There could be more. There'll be more attacks. It could go on for weeks, maybe less. It all depends on, I guess, what happens with Iran itself, the new government. How long can this kind of go before it's already worrisome, but then it really gets worrisome?
Well, I think a lot of this will depend on how strong Congress wants to be in the face of this. Because, again, keep in mind, we're dealing with the midterm election year in the States. Affordability has been one of the key themes going into these elections. Well, if oil is going to go to $100 a barrel, we kind of know what's going to happen to gasoline prices in the States. And therefore, we're going to go backwards on affordability. So it'll be interesting to see how much more back pressure Congress applies. Again, coming back to the affordability issue, Roger, we've been talking about, can the U.S. reaccelerate in terms of the economy? Can we see this in a low inflation environment? Can interest rates decline further? Well, a lot of that gets thrown out the window if we're talking about a 4-week affair where now the inflation outlook is going to be completely up in the air. And again, we could see inflation coming back. So this has repercussions beyond what we're just seeing in the markets today. I would argue it has repercussions in terms of what we see the consumer doing this year and what happens to the overall level of inflation.
And you feel this could push the U.S. into recession?
I think the probabilities will go up. If we're at this for 4 weeks, Roger, if you and I are talking about this at the end of March, with oil prices up where some analysts think that we could see, I think it would be naive to think that the U.S. economy could just shrug this off. Interesting thing to keep in mind, before we came into the weekend, we were talking about something called AI and what impact that may have on labor markets and ultimately consumption. That was before we even got into this. So now you're just kind of layering a risk on top of that. So, yeah, I think the probability of a setback in the economy moves higher the longer we're at this.
And then what about Canada relative to that?
Well, Canada is not going to be immune from this. Obviously, we're talking about it this morning, Roger, in terms of airlines, in terms of travel. We're sensitive still to what happens in the U.S. economy. So we don't get away with this with no impact. But I would argue, and we're going to see this in the markets this morning, that the TSX is going to have more resilience than the markets in the States, simply because we still have a very strong energy sector and a well-capitalized financial sector. I think that ultimately keeps the Canadian equity story, above what we're seeing in the States in terms of where do we want to be positioned.
And where do you go with this? You're looking at all this. What are you doing right now? Who are you looking at?
Well, right now we're looking at the energy sector in terms of where we want to be, especially in Canada. One thing to keep in mind when we talk about, oil supply, those producers that have a high degree of sensitivity to that region in terms of getting output out of that region are going to benefit from higher prices, but they're also going to be disenfranchised by weaker volumes. Compare that to Canada, Roger, where we've got a lot of our energy producers really are not wedded to what is happening in the Straits. We do ship oil by pipeline, and we can ship oil from either side of the country. So I think the Canadian energy patch is where we're focused on right now, where we want to have that exposure. And I think ultimately for the economy itself, unless this becomes a protracted affair that drags down global economic growth, Roger, to the point where it does hit Canada, we're still comfortable here.
Yeah. And CNQ is one of the ones you're liking right now.
CNQ, I think, is one of those Fort Knox stories for Canada in terms of the energy patch. It will benefit from higher prices for crude. It doesn't have the same sensitivity to shipments through that region. A lot of its production, Western Canada, the North Sea, which is one of the reasons we like the stock. And of course, it pays a handsome dividend.
All right. And looking the other way, this is just, we're pulling in a stock you're not liking so much right now, Western Union.
Yeah, again, getting back to my earlier comment, the AI story has not gone away just because the U.S. attacked Iran over the weekend. That displacement thesis of companies that ultimately are going to be, negatively impacted by the usage of AI, whether it's mid-level software companies, Roger, or in the case of Western Union, a company that really has benefited from this ease of transfer of money, which now is going to be facing competition from other firms in the financial sector that now can use AI tools to generate that transfer of money more efficiently. So I think we're going to see some margin compression with respect to Western Union. So it's a stock that we don't think really we want in the portfolio today.
Now, are they not, I assume they were looking at AI. Would they not be starting to implement it as well, though? And because they do this for a living, staying ahead of anybody else?
Oh, absolutely. They have no choice but to do it. The question now becomes firms out there that can deploy more capital, relatively more capital to these technologies and benefit from that. And I think that's ultimately where Western Union probably is not going to stand up as well against some of the larger titans in the financial sector, whether it's the States or globally.
I wonder if they'll have to go back to ponies, riding the ponies.
They might have to.
All right, Andrew, thank you as always for joining us.
Thank you, Roger. Pleasure.
Andrew Pyle is a senior investment advisor and portfolio manager at CIBC Wood Gundy.